carefully, and then focus ruthlessly. An example I have here is a client that we've represented, Live Yearbook, has a technology for a software as a service platform that could be very useful for churches, for nonprofit organizations, for the Navy, where cruise books are a big industry, and for yearbooks, for schools. That team, looking at that huge market, focused on yearbooks. The importance of that focusing ruthlessly is investors are going to say, you can't pursue 2 or 3 or 4 different markets. You're going to be short of people, short of money, short of time. You're going to have to go over them sequentially, at least to start. So make sure you pick a market and don't run with a plan that says live annual books for schools, navies, charitable organizations, etc. As I said before, obviously you want to get a feel for the size of the market and the growth. And all other things considered, a growing market is of smaller size is sometimes more attractive because it's easier to get new customers in a market to come to a product for the first time. Think of Apple computers. Is it easier to sell an Apple to someone who's never had a computer, or is it easy to sell an Apple to someone who's on their 4th PC? Probably easier to sell someone who hasn't had a computer before. Not that you have to have growth, but remember, growth, if you've got it, is a very powerful tool. Talk about the competitive position and who the competition is, and just realize that one of the things that bugs VCs more than anything else, and they make fun of more than anything else, is, and then they told me they didn't have any competition. There's always competition. Look at Live Yearbook. No one does a SaaS platform. No one does it that way. Well, do we not have yearbooks today? Of course they have yearbooks today. There's another way of doing it. Or people get around a problem by solving some other problem. So make sure that you identify the competition. It's also an opportunity for the investors to say, if I as an investor can run out and find 4 competitors that you haven't already mentioned to me, then you don't look very in touch with this market. And one that a lot of people overlook is to think about access. How are you going to get to these customers? What's the business model? And in that business model, what are the barriers? I was looking at a company recently that has a really wonderful product. The problem that they're wrestling with is that they said the end user, it's a really compelling product. The problem is to get it to the end user, you need to get to the people that are servicing them now. And to get to those people, you got to get them to distribute your product. And if they have any brains at all, they'll realize that what your product is going to do is take them out of the market. So, powerful enemies, I always like asking entrepreneurs, whose ox are you going to gore? Who out there is going to say, this is bad for us, and what power do they have? So always look at access. In terms of the technology, what you want to do in a business plan is speak to the intelligent layman. If you've focused on VCs, and you've picked people you're showing the investors you're showing it to, as you should, based on people who are potentially interested in your area, you can assume, and 90% of the time plus you're correct, that they have some familiarity with the technologies that play in your area. They're lay people generally, but they're curious, and if this is an area they invest in, they're going to know something about it. So don't address your plan to the expert. The typical VC may have an engineering degree, but the typical VC got that engineering degree 30 years ago. They've invested in companies, but they're not primarily technologists. So, along with that, I'd say don't disclose anything in your business plan that's really proprietary. VCs and most sophisticated investors are not going to sign NDAs. And if you think about it, you really don't need to disclose anything proprietary in almost any case if you're talking about showing a layman something. Particularly, and I'd say here, it's okay to have a black box. You can build some credibility around the black box by who you are and what your experience is, what the team brings to it, and who's behind the project. As I said on the technology, address the obvious objections. Don't try to anticipate every possible objection. But address any objections that are like, well, the first thing I'd say is, how are they going to make a protein orally available? If it's a biotech company, oh, geez, they got this huge protein, and they say they're going to use it to treat the flu. Well, won't it have to be orally available? Or I'd say, we realize it's not orally available, but, so address the obvious objection, use credibility enhancers. Here's where you can have a board of advisors. or board of directors or people on the team who have some real credibility. Finally, I'd say don't oversell or overpromise. These investors, if you get the meeting with the investor and the first thing they find out is that you oversold them and didn't disclose something about the technology, you've lost your credibility and you're almost certain never to get it back. So don't oversell or overpromise or overstate what you're going to be doing. And make sure you touch on the intellectual property status. Is this your idea? Is it protectable? Is it protected now? Do you have a strategy for developing an intellectual property portfolio? So you want to figure out if you do have serious intellectual property protection possibilities, you want to bring that out. If you don't have it, that's fine. If you're building a model on first mover or whatever. But if you've got intellectual property assets and strategy, you want to make sure you bring that out in the technology section. The next area we want to look at, if I can make the computer work, is the team. One of the tritest phrases in venture capital or rules is that an A team with a B opportunity is a better investment than a B team with an A opportunity. And what makes an A team, the bottom line is experience counts. And the ability to say, I've been here and I've done this. I've been in a venture-backed company as a senior manager. And you don't even necessarily have to have succeeded, but you went through the cycle. Now, if you succeeded, that's great. Although I've met VCs who will say they only invest in people who failed. So, but the relevant experience that's best is, I've done this before. I've worked in this market in a small venture-backed company. And we've succeeded or brought it to some sort of conclusion. And finally, or related to experiences, shared experience is a big plus. Now, a lot of times, I've worked with young entrepreneurs. One of the most successful deals I did as an angel involved 4 guys who never worked together before in a business. They were young, they had very little business experience, a couple of years of sales experience each. And they were going to start what became a fairly significant B2B commerce company. Yes, and yes, they got out before the bubble burst. But what those 4 guys did have, well, they couldn't say, we've been here and done this. They could say they've all flown combat helicopters in the first Gulf War. They'd worked together. They'd been essentially putting their lives on the line together in highly stressful situations and had worked together as a team. And that's really valuable because your startup is almost certainly going to be a high-pressure situation. It's going to have ups and downs, place a lot of stress on managers. And it's good to know, can this team handle serious stress of any kind and continue to work? You can also bolster a weaker team with advisors. The key with the advisors is to make sure they really are independent. This is my brother-in-law. It's generally not going to be a good thing. Even if the brother-in-law has a Nobel Prize, it's probably not as strong as it could be. They have relevant experience in the market, in the technology, or just in the investment community. They know VCs, they've raised money, and the fact that they got involved with your deal gives some credibility. Generally, you want to avoid, oh, we've got the perfect person for this, and they'll join when we have the cash. One of the things VCs are skeptical of, and I think properly, is people who say they'll commit only when they're not taking a big risk. So, while you may say at some point we're going to recruit someone, that's fine, but just saying, oh, and Bob here has agreed to join us as soon as we raise $2 million is generally not going to be a good pitch. Finally, address any obvious holes. And the biggest obvious hole in most startups that I've seen is who's going to be the CEO for how long. Now, if you have an obvious CEO candidate, that's fine. Present them as such. And indicate this person's on board. But unless it's someone who's been there and done that before, i.e. who's made a lot of money for VCs in a senior management role, unless it's an obvious CEO, always address the need, indicate your willingness to grow the management team, and at the appropriate point, if it's needed, to bring in someone with more experience to take the company to the next level. A lot of times, if you address this up front, and you convince people that you will, if it's appropriate, look on, they're willing to go with someone and say, well, maybe they'll grow into the role. I know I've been involved in deals where I'm looking and saying, well, this person could grow into the role. But it's nice to know they ultimately are not about being CEO, they're about making the business work. In terms of the financial model, First thing to remember for startups is cash is king. No one really cares for most high-impact business startups, early stage development companies, what the GAAP financials look like. They care about how much money do you have, how much do you burn, and when do you run out. Focus then on the key drivers of the business. What are the revenue drivers? How many customers are you assuming you'll get? How many of that come into the pipeline? Focus on revenue drivers and assumptions. Focus on headcount. Headcount's expense. That's where you're going to start seeing what your burn rate is. And then in my experience, again, it depends. A software company might be monthly and quarterly statements, monthly for a year, 2 years, then go straight to quarterly and a year later. A biotech company might be longer in terms of more detailed finances. But basically give people at least a quarterly look into where you think you might be needing to raise the next round of money before you get to sort of annual estimates. In terms of the numbers, you want to be aggressive, but you need to pass the blush test. So by that, what do I mean? Well, not too big. Too big would be you come into a market that historically the leading market share has been 20–25%, and you say that in 4 years you're going to have 98% of the market. People aren't going to believe that. Every now and then it happens. But even Google doesn't have 98% of the market, right? So every now and then you get someone who breaks the mold, but usually you can look at markets and say, look, if we're one of the industry leaders in 5 years, that's 25% of this market, that's huge. At the same time, some people go the opposite way and they're too small. They'll say, oh, well, there's 1 billion people in this market, so we only need 1%. But if you look at that market and say, but the leading players in that market now have 15, 20, 25%, no one wants to be a 1% player in a market where someone has 25% of the market. It's a recipe for going nowhere. If your product and service is so good,